Hello everyone. I just wanted to do a quick video before I go off on holiday today until the first day of January. Well, we are at minus 88 in the risk dial. I haven't seen minus 88 since God was a boy, and basically minus 88 was at the depths of September, October of 2008, when it actually got to minus 97. What that tells you is that you should be avoiding risk and taking any opportunities of any kind of bounce to sell whatever it is that you don't like in your portfolio. I don't think this is going to stop anytime soon. At some stage you might get a real flush down to some very important levels, which I will now try to discuss with you. What do I think is happening? This chart is really telling you what is happening. You have bank margins, the blue line, going almost negative. The Fed, by hiking interest rates, has ensured that overnight money stays expensive, while the bond market is pressuring 3, 4, 5-year yields, and that is making sure that the banks have zero margins. If the banks have no margins on lending, they have no interest in lending. If they have no interest in lending, they won't, and that will actually make the economy have less liquidity. Less liquidity means less activity, and therefore the stock market is discounting that fact. You can see what is happening to XLF. It is unlikely that that will stop at any, hard here. We could have small bounces for sure, but that doesn't mean that one day we don't get a real flush down. The only way to avoid that is to be positioned, because once the flush starts, you won't be able to get in. You just have to have call spreads in bond markets, and now I'm going to have a look at those. Here is a yield chart of the 5-year. It looks like we still have time. We might have a few days, maybe even weeks. If we you can see that we are hard against the lower Bollinger Band, but that, if there is a real flush, will not mean all that much. The fact that we are staying well below the 200-day, the 50 days coming in rapidly to give a sell signal, even if we stay around here for 3, 4, 5 days, all it means is that the kinetic energy will be even higher, and then we get a real flush down to below 250, which will be negative curve all the way from overnight to God knows what. That is very frightening. Volatility is probably too low. You have to have some call spreads. If you don't, and you just won't be able to trade against your to trade the stock market at all. There will be opportunities from the long side and from the short side, but you'll be just too scared to take any long opportunity, because you'll be fearing the flush, or at least I will be fearing the flush, and that you're buying into the flush. If you don't have this position offsetting your long position when you buy it for a trade, you will just be like a rabbit in the headlights. I'm just telling you the way I am. Therefore, I have to have positions which are long of calls on volatility and call spreads on bonds, and therefore short yields. This is a monthly chart of SPY. We are now below the monthly Bollinger Bands. If we enlarge that, you can see that the monthly Bollinger Band is at 2550. The fact that we are breaking down here and we are so disconnected might mean that we have got 1, 2, maybe 3 months worth of time here. The fact that we hit the 0.382 retracement of the whole move from 2016 actually is probably a bullish development. But to me, all that means is that we have time as opposed to anything else. The 50% comes in at 2,370 on the SPX kind of thing, and that is where the 200 week moving average is, which I think is unlikely to be really stopped out. But if we just do a very simple projection such as this, if we go from the, let me just do this properly, if we go from there to here, back up to there, we get these projections basically saying that the minimum is 2437, and really the maximum will be here at 61.8 retracement, which is around 23.88, which is what, 2240 in SPX terms. It is just telling you that the path of least resistance is down. The fact that we might have even a month or two of sideways action now that we've broken, to me is very, very little solace. This market is on a one-way mission down. We might get bounces of 1, 2, 3, 4%, just as the risk dials say we could, but that doesn't mean anything in the context of the next 3 or 4 months. If we now go to the weekly, we have the 200 week moving average at 2350 odd. That seems to be a good target over the course of the next 5 or 6 weeks. This has been a very violent move. It would not really surprise if 1 or 2 or 3 weeks it went sideways and then went down again, would it? But it gives you the direction. You have the risk dial, you have all the moving averages turning over. It is just not worth speculating that it's going to hold in for 1 or 2 weeks. It's just not worth doing. You could come in one morning and be completely surprised. Don't do it. Get some call spreads in the bonds on board, and then you can trade both ways. NQ, the high beta stuff, looks particularly awful. Look at all these moving averages up here about to cross. It's just frightening. We could go down to well below 6,000, 5,800, something like that, given a bit of time. Pretty damn frightening. I just would not want to be too long of this stuff. It's obvious, isn't it? As far as the dollar is concerned, well, we are right at the very, very important 114.80 level that has been so important for such a long time. Below it it's bearish, above it it's bullish. Use that as the defining level. If it closes above that, it's probably going all the way to the 200-day moving average, which is just below 117. So you have at least 2 percentage points to play with there. Is it going to happen? Possible. Even this chart says maybe 1 or 2 weeks worth of hesitation and then up, which basically means it makes sense, because I don't think anybody really wants to have too big a position in front of Christmas. The market that is most supported, and the one that I like the best in relative terms, i.e. they're all crap, but this is the least crap, is actually the Nikkei. It has the 200-week moving average quite close to it. It will break, but I think it'll break less than ES. So being long of Nikkei, short of ES makes sense. But even this, look at these moving averages. I mean, this is, this is really, really, really bad. It's looking, look at it. I mean, it's technically speaking, it's appalling. It might be the best of a bad lot, but I really would not want to be long-term long of anything here. Yes, there might be bounces, but you have your defined levels. sort of anything, first of all around 2,800 and then around 2,000 to 21,250, you want to sell into it in a major way. Volatility is also saying that we might have some time of sideways trading. I wouldn't bet on it. It's not a bet worth making. If we just enlarge what is going on here, every time it comes down to this red line, which is or the 50-day, it's just supported. So any moves back down towards the 23 area in volatility are worth buying call spreads for moves that could go well into the 30s. Finally, even the venerable Dow theory has finally given a sell signal. The transports have taken out the lows that they established in February, and now even the Dow has taken out those lows. That is a old-fashioned Dow theory sell signal. Any bounce towards 24,000, I think, is going to be a major sell signal for probably a move down to 21,700. I think in the next few weeks in the Dow. So that is almost another 7% or something. Not good. Okay, not good. It's a frightening period. You've got to have some call spreads on board. Don't bet that time is going to be on your side. It might be for a week, and then in a few minutes it won't be. This is going to be an extreme lack of liquidity. Good luck, and don't be caught short of volatility or bonds. Thank you very much indeed, and good luck to you. Happy Christmas, Happy New Year, and I will try to tweet whenever I can, but don't count on anything too much until January. Thank you so much, and bye bye.